Hi, I'm James Robinson, and this is my stock pick of the week. This video is on the dividends for NuSkin, symbol NUS. And when we're looking at dividends for a company, we don't just want to look at what the dividends are and what they've historically done. We want to dig deeper and get a sense for how likely is it the dividends will continue, and better yet, how likely is it the dividends will increase over time. So when looking at dividends, I think that we need to look at two factors. The first one is the amount of dividends that are paid. So that's the total size of the checks that the company wrote to shareholders in the form of dividends. The second one we'll look at is dividends per share. Oftentimes those don't move up in lockstep because the company has perhaps been buying back shares or selling shares. And as a result, the amount of money paid in dividends is being paid to fewer shareholders, and thus you're making more money in dividends per share. So this is a company where that kind of analysis makes sense, because if I just look at dividends per share, I see the dividends have gone up basically every year since 2000, and that's fantastic, and we love this company, and let's go buy some stock. But when you look at the dividend total dollars paid out, you see that actually, interestingly enough, from 2015 to 2018, the amount of dollars paid out to shareholders actually decreased gradually. The dividends per share was able to go up because they had bought back a bunch of shares, but still, I don't like to see, if a company's more and more profitable every year, it should be able to afford to pay shareholders more and more money every year. Now, in this case, I suspect what the company has done is simply said, we're going to buy back shares instead of paying dividends. We're not just going to do both because we only have a certain amount of money, and we would prefer to do it in a way which is tax advantage to the shareholders, and buying back stock, by some arguments, is tax advantaged. It also, however, allows management to look better and better because the same amount of earnings are being paid to fewer shares, so the earnings per share goes up, even though the total dollars earned doesn't go up. So nothing really nefarious here. It wasn't a gross reduction in commissions, and it wasn't, and the dividends per share for the shareholders did go up. But as you're going to see, the dividend didn't go up very much, which is sort of a bit of a bad sign. All in all, what I think I'm going to tell you about this company is the dividends are nice, but they are not so spectacular that I would buy this stock as a dividend stock. So again, we do a deep dive when looking at companies. So we look at the dividends, we measure them in four factors. The first one is yield and growth. So that's what you obviously would see is, what's the dividend per share? So how much, if I buy a share of stock, what's my yield? The growth is how much has that gone up every year for the past few years, and is that likely to continue? The next thing we do is we look at the dividend safety in the context of earnings. So is this company's dividends appropriate for the amount of money they're making? And is it something that could be sustained, the dividends could be sustained in an off year or off couple of years? So that's the second thing we look at. The third thing we look at is dividend safety in the context of cash flow. Cash flow is important because that's how much money is coming in and going out every day. And oftentimes companies can do strange things with the books, but it's hard to do something with the cash flow. So we want to make sure that the dividends are being paid are appropriate for the amount of cash flow the company has every year. And the final thing that we do is oftentimes companies will have debt, and that debt is not easily get rid of, especially if the market turns. And if the markets return and interest rates were to go up, would interest payments gobble up all the money that would otherwise be available for shareholders? So we look at dividend safety in the context of the current debt load. So here you can see that the dividend yield for this company is excellent, 3.11%. The average dividend yield for the S&P 500 is about 1.57%. So it's literally almost exactly double the dividend yield you get from the average S&P 500 stock. What that tells me, it's also a number that is at or about the rate of inflation, maybe a little higher than the rate of inflation. So I'm not losing money by holding this stock, right? If I buy this stock and hold it for a long period of time, the dividends throw off enough cash flow that I'm not really losing money on the stock as I wait for it to rebound. Dividend growth, however, has only averaged 1.4% in the last 5 years. I don't really like that. I'd like to see that number, frankly, significantly higher. It did go up last year, so I would keep an eye on this. What I would tell you is, if I was a pure dividend investor looking for retirement money, NuSkin might not be the stock I would buy. I happen to think the stock is cheap and is going to go up in the short to midterm. But while I wait, I get paid a nice dividend, so that's kind of doubly attractive. The chart is a little bit, I got to come up with a better way to show off this chart. So the orange bars are the percentage increases each year, and the percentage increase has decreased, but only marginally. If you look at it, it's gone from $1.5% every year to 1.4%. So effectively what they've done is they've increased the dividend by a few cents each year, And that's a tiny fraction of, whatever it was, $1.39 the first year and $1.46 last year. So it's just very, very tiny increases. So the blue line is the amount of money paid in dividends as measured off on the left side of the chart. And the red bars are the increases as measured on the right side of the chart. So hopefully that makes sense. So this chart looks at dividend safety in the context of earnings. So what we're really measuring here is if a company has X number of dollars of earnings, how much money is the company paying out to the shareholders? So you can imagine if a company had $100 of earnings and they were paying out $1 to the shareholders, well, that'd be a number they could probably do indefinitely. If on the other hand, a company had $100 of earnings and was paying $200 out to the shareholders, that's a number that cannot be sustained for very long. So we like to see if that number can stay in sort of a safe range where we believe that, if the company has a bad year, an off year, it's not going to be so much the company's digging into savings to pay the dividends. They can pay the dividends out of that year's earnings. So the current payout ratio for this company is 47.7%. It's averaged 58.9% over the last 5 years. The average payout ratio for the S&P 500 is about 40%. So I look at it like this company is paying more than the average company is in dividends. I'm actually not that concerned about it because I know it has very little debt and has pretty stable earnings. If I had seen this number at 70 or 80%, I'd get very nervous. But when I see it at this level, I just think this company is actually, the management is doing a pretty good job of trying to take care of us, the shareholders. So again, the green bar on this chart is the earnings, and the red bar is dividends per share, and then the payout ratio is the blue line. And it looks like the payout ratio has sort of come down last year, which is good. And I'd like to see that payout ratio about 50%. I'd be totally fine with that. This is the second measure that we use to figure out, the second measure we use to figure out the safety of a dividend. And what we're looking at here is dividend safety in the context of cash flow. So it's exactly the same analysis as we did from earnings, but I think the cash flow is often a more accurate representation of how a company is doing, especially in terms of the safety of a dividend. So looking at the last column in 2019, 2020 hasn't reported yet. The cash flow from operations were $177 million. The capital expenditures were $3 million. So they didn't spend very much on capital expenditures at all, which is one of the things I like about this company, is they don't need a lot of money for capital expenditures. The free cash flow was $174 million. They paid $82 million in dividends. So they paid 47% of their free cash flow in dividends. That's completely safe, no problem there. And the company has averaged a payout ratio of 36% over the last 5 years. So again, they've been very, very stable on this front. Again, what I really see is that the dividends for this company are very, very stable. I think they're very safe. I think you're going to continue to get them. I am concerned that they're not growing as fast as I'd like, and maybe not even as fast as inflation. Hopefully that rectifies this year. The final measure that I look at when looking at dividends is dividend safety in the context of debt. Now, this isn't generally a problem with the companies that I suggest you invest in, because the companies that I suggest you invest in typically have very little debt. But I want to highlight that because I think if you run this analysis through a lot of companies, especially a lot of companies that have a really high dividend yield, like a disproportionately high dividend yield, you'll see that maybe that yield isn't very safe and it's not going to be there for you when you really need it. And one of the reasons is because interest rates can only go up, and when they do, the extra interest payments will gobble up all the company's earnings. Not really a problem with this company. So let's just look at this chart. On the left side is the interest rate. So that is if the company's current debt all of a sudden got refinanced at this rate, what would the debt be, and how would that debt service affect the company's ability to pay dividends? So as you can see, if the company is paying 4% interest, it would reduce their cash flow by $17 million because they pay an extra $17 million in interest payments. And you can see that at 20%, they pay $88 million more in interest. So hopefully that makes sense. So the new interest adjusted cash flow is simply the number we looked at on the last chart minus this additional interest payment. And you can see that they'd have $157 million of adjusted cash flow at 4% interest, and they'd have as little as $86 million of adjusted cash flow at 20% interest. The dividends will remain constant. That's actually what the company paid in dividends last year. So that tells you the free cash flow minus dividends and the dividend payout ratio of various debt levels. So, even at 10% interest, they're only paying 60% of Their cash flow to dividends, adjusted for the interest, no problem at all. Company can actually go to 20% interest and still be able to pay the dividend out of their current cash flow. So that's really fantastic. That tells me the company has very little debt and that it's very safe and that the dividend is not going to be in jeopardy because this company has too much debt should interest rates rise. So that's it for NuSkin for the dividends. Again, I like the dividend. 3% is something that I don't mind holding this company for a long period of time, waiting for it to recover. I'm not so happy with the rate that it's gone up, but I think the dividends are very safe when looked at in terms of earnings, when looked at in terms of cash flow, and when looked at in terms of debt. So again, I think this is a company you should be comfortable buying.